What's up, channel members? So a lot of you guys have been asking me, especially the new channel members, Adam, how do we buy options? What does it mean a strike price? What does it mean a duration? What does that little number of the amount of the option? What do all of these things mean? And in today's video, I am planning to show you that. So let's get right into it, shall we? All right, guys, this is my Robinhood account. Now I'm going to show you how to actually buy options. By the way, the easiest way to buy options is using Robinhood. If you guys need a link to Robinhood, I'm going to leave it in the comments down below. You're going to get some free stocks as well. Over here, just type in any stock that you want. I'm going to pick PayPal because this video is specifically for my man Nate, who's been asking me to show him how to buy options, specifically PayPal. So now you're going to click on PayPal. This is what you're going to see. On the bottom right-hand side, you're going to see this little button that says Trade. I want you to click Trade and then Trade Options. When you click Trade Options, I want you to just click Long Calls. When you click Long Calls, on the top, there's going to be a bunch of dates. August 18th, August 25th, September 1st, so on and so forth. A lot of people on this channel, including myself, have an options chain. If you go all the way to the right, for January 2025. Not June, not December, January 2025. Click on that. Now, go all the way up. You're going to see this thing for $145. So if you click on this for $145, I'll explain what it is. So you're saying that you believe by January 17th, 2025, the price of PayPal is going to be $145. Now, when you buy this, the price of PayPal does not need to be $145 by January 17, 2025. Because what you're going to end up doing is trading this option. You are going to sell it well before the expiration date. So 145 is a strike. Let's say PayPal hits 150, you can buy it for 145. Let's say PayPal goes to 300, you can buy shares at $145. That's what the strike price means. But again, you're going to be selling it before that. Why? Options have two types of value, intrinsic and extrinsic. Intrinsic is the actual value of how much the option is worth based on the price, the current price, and the expiration price, the strike price. And extrinsic is the time value, the value in price. Now, what you have over here is on the bottom, you're going to have something called the Greeks. You see, delta, gamma, theta, vega, rho. Theta is the most important one. Theta is the amount of decay that you're going to be getting. That means that every single day you're going to lose 0.0060 of this option every day. But that number changes. The closer you're going to get to your expiration date, which is January 17, 2025, that number is going to get a lot higher. And eventually your extrinsic value, which is your time value, is going to decrease. You don't have to worry about that. Just a rule of thumb. You want to sell out of your options 3 months before expiration. So even though this is for January 17th, we're actually going to go to December 15th, November 15th, October 15th, which means October 2024 is the last date or so that you want to be trading this option, unless you're in the money. If you're in the money and the price of PayPal is above 145, then the theta decay is non-existent. So now, if you press buy, you're going to buy one option. Every option is worth 100 shares. So when this thing says 1, that's 100 shares. If you're going to do 10, that's 1,000 shares. If you're going to do 100, that's 10,000 shares. How do you know? You see on the bottom left, it says max cost, $1.24, which is the contract price. So when you see $1.24, it's per share. Every contract has 100 shares. Therefore, $1.24 times 100 shares would be $124. If you want to buy 10 options, like I said, it'll be $1.24 times 1,000 shares. If you want to buy 10,000, if you want to buy 100 options, it will be 124 times 10,000 shares. So if you buy this, all you got to do is press review, and then you just swipe up and you could buy this. But right now it's out of hours, so you're not going to be able to buy it. But that's the options play that most people have right now when it comes to PayPal on this channel. I hope that explains it. Now let me show you something else. Go back. Now instead of PayPal, I want to show you Palantir. And instead of, you're going to press trade options, but instead of pressing long call, you're going to do covered calls. Covered calls also you can do by different days. So when you're buying a call, you are buying the option to purchase shares at a certain price at a later date. When you are selling calls, you are selling somebody else that call. So covering a call is somebody else is buying them from you. So you are selling this to somebody at a later date, and you are collecting a premium. Instead of you paying that $1.24, you would collect the $1.24. When I am selling my options, I like to do them 1 week, 20% out of the money. So for example, right now the price of Palantir is $15.42. Approximately 20% from $15.42 would be right around $4. So I would go up to this one right here, which says $19.50. $19.50 would give me 3 cents a contract. So if I click on this, I would then press sell. Whenever you're seeing a price, there's always going to be a bid and an ask. An ask is the highest. A bid is what people are actually paying. So even though it says 3 cents, you're actually getting 2 cents. Remember, it's 2 cents per share. So if you're selling one contract, that's 100 shares, 2 cents per share. I will be making $2 for this specific contract. And I hope I explained to you buying and selling call options. One more thing. If you do this for an expiration, and my expiration is going to be 8/18, if the price of Palantir does not hit $19.50, I don't have to sell it, and I collect the premium. I don't got to do anything. If the price of Palantir hits $19.50, all I got to do is sell my shares at the strike price. So whenever you're selling covered calls, make sure to sell it at a price that you're comfortable selling. For example, instead of $19.50, you could also do 20 or $20.50. You could do 21. You could do $21.50. You could do $22. You could do $22.50. You could do 23. And at $23.50, nobody is actually gonna buy them because it goes to 1 cent, which is going to be zero. Remember, you're losing about a penny between the bid and the ask. Don't sell covered calls unless you are prepared to sell your shares at a certain strike price. So this is a very lucrative strategy. Some people make a lot of money. Some people make a little bit of money depending on how many shares you have. I literally make a weekly salary. I don't even have to work. And I make essentially a weekly salary selling covered calls on my options. Some covered calls are going to be more lucrative 1 week than another week. For example, the week of earnings, Palantir was giving, instead of the same covered call 20% out, instead of 2 cents, you would be getting like 10 cents. It was ridiculous. 12 cents. It was super good. I calculated that you're going to be getting around 6.5% to 7.5% returns on your money if you're selling covered calls every single week. I find that this is pretty safe, 20% out of the money. And even if I do get called, I'm okay selling for 20% on top of whatever the price is today. Remember, this is only for 1 week. I hope this helps people. I hope you guys are understanding this video. I hope it answers your questions, Nate. I'm sorry for the quality of the video, but my son is playing in the backyard and I really needed to get this video in before Monday's open. I'm coming, my love. I'm coming. Guys, I'm going to go play with my son. I love you all. Thank you so much for being channel members. If you have any questions, please feel free to ask. Bye.